A strait narrow enough to swim across is holding the entire global economy hostage. 33 kilometers. That is all that separates the Persian Gulf from the Indian Ocean. 33 kilometers of water that, on any given day, carries nearly 1/5 of all the oil consumed on this planet. And right now, that stretch of water is at the center of one of the most dangerous military standoffs in recent memory. But here is what the headlines are not telling you. While governments scramble, while oil traders panic, and while energy ministers lose sleep, one country is quietly being repositioned as the most valuable energy supplier on the planet. And it is not Saudi Arabia. It is not Russia. It is not even the United States. The country that stands to gain the most from this crisis might genuinely surprise you. And by the end of this, you will understand exactly why. To understand what is at stake, you need to understand one simple truth. The global energy system was built around a single choke point. The Strait of Hormuz connects the Persian Gulf to the Indian Ocean, and despite being only 33 kilometers wide at its narrowest point, it functions as the circulatory system of the world economy. According to the International Energy Agency, approximately 20 to 21 million barrels of crude oil pass through this corridor every single day. That is nearly 20% of total global oil supply, moving through a gap of water smaller than the distance across many major cities. But oil is only part of the story. Close to 1/3 of all liquefied natural gas transported by sea worldwide also flows through this same route. Countries across Asia and Europe depend on these shipments to keep their power grids running, their factories operating, and their households heated. What makes Hormuz uniquely dangerous is not just the volume. It is the fact that there is no viable alternative. There is no bypass, no parallel route, no backup system. If Hormuz is disrupted, the energy math for the entire planet changes immediately and dramatically. Immediate market reaction. The market did not wait for a formal conflict to begin. It never does. Within hours of credible reports surfacing about security risks in the Strait of Hormuz, international oil prices surged sharply. Brent crude and West Texas Intermediate, the two benchmarks that effectively set the price of energy for the entire world, both spiked as traders began pricing in the possibility of a prolonged disruption. Simultaneously, major shipping companies started suspending or delaying voyages for oil tankers and LNG carriers transiting the region. The logic was simple. No shipping company wants to send a vessel worth hundreds of millions of dollars through a war zone. Gas markets moved just as violently. Europe and Asia, both heavily dependent on LNG imports from the Middle East, saw significant price volatility almost overnight. What had taken months to build during previous crises was now happening in a matter of days. The domino effect on the broader economy. Energy is not just one sector of the economy. It is the foundation every other sector is built on. When fuel prices rise, transportation costs rise. When transportation costs rise, the price of every single good that moves through global supply chains rises with it. Groceries, electronics, pharmaceuticals, raw materials, nothing is immune. Analysts began warning almost immediately that a prolonged crisis at Hormuz would not just be an energy market problem. It would be an inflation problem, a manufacturing problem, a trade problem, a full-spectrum economic shock delivered through a single narrow waterway. And the timing could not be worse. Global supply chains are still operating in a fragile state following years of disruption. The buffers that once absorbed these kinds of shocks have been worn thin. Another major hit could push several economies from slowdown into something considerably more painful. Who gets hit the hardest? Not every country feels this pressure equally. India imports more than 85% of its crude oil needs, making it perhaps the most exposed major economy on the planet. Any sustained disruption to Middle Eastern supply routes puts New Delhi in an extraordinarily difficult position, forced to choose between economic stability and energy security simultaneously. Japan and South Korea face a structurally similar problem. Both nations possess virtually no domestic oil or gas resources of significance. For decades, their energy security has depended almost entirely on smooth passage through Hormuz. When that passage becomes uncertain, their vulnerability is not theoretical, it is immediate and measurable. Europe carries its own version of this anxiety. After the severe energy crisis of 2022, European governments have elevated energy security to the same strategic priority level as national defense. Any new disruption to global energy flows now triggers a political response, not just a market response. Governments across the continent are watching Hormuz with the kind of attention usually reserved for direct military threats to their own borders. The common thread running through all three regions is this: they built their energy systems around the assumption that Hormuz would always remain open. That assumption is now being tested in real time. Here is the part that most analysts are underreporting. While energy ministers in Tokyo, Seoul, New Delhi, and Brussels are running crisis scenarios, while traders are repricing risk across every major commodity exchange, and while shipping companies are rerouting vessels away from one of the most critical maritime corridors on Earth, one country is receiving phone calls it has never received before. Long, serious phone calls. From some of the largest energy importers in the world. That country is Canada. Not the Middle East. Not a new offshore discovery in some emerging market. Canada, a country most people associate with ice hockey, maple syrup, and polite border crossings, is suddenly being looked at as one of the most strategically valuable energy suppliers on the planet. And the reason is not just about what Canada has in the ground. It is about what Canada is not. It is not located near a military conflict. It is not subject to the geopolitical instability that makes Hormuz so dangerous. It does not sit inside a region where a single miscalculation between rival powers can shut down a fifth of global oil supply overnight. In a world being priced for risk, stability has become the scarcest commodity of all. The scale of what Canada actually holds. Most people dramatically underestimate how much energy Canada is sitting on. According to data from the International Energy Agency and the U.S. Energy Information Administration, Canada holds approximately 163 billion barrels of proven oil reserves. That figure places Canada fourth in the world behind only Venezuela, Saudi Arabia, and Iran. Let that land for a moment. The country most people think of as a mid-sized, quietly prosperous democracy holds more proven oil reserves than Iraq, Kuwait, Russia, or the United Arab Emirates. The majority of those reserves are concentrated in the oil sands of Alberta, one of the largest hydrocarbon deposits ever discovered on this planet. Decades of technological investment and infrastructure development have transformed what was once considered an economically marginal resource into a highly productive extraction operation. Current production has reached close to 6 million barrels per day, placing Canada firmly among the top oil-producing nations on Earth. That volume does not just cover domestic needs. It creates substantial export capacity, and that export capacity is now attracting an entirely new class of international buyers. The new weapon, LNG Canada. If the oil sands represent Canada's existing power, the LNG Canada project represents its future leverage. Built in Kitimat on the Pacific coast of British Columbia, this liquefied natural gas facility represents a total investment of approximately $40 billion US, making it one of the largest private sector energy projects in Canadian history. The facility takes natural gas produced in Western Canada, liquefies it, and loads it onto specialized tankers bound directly for Asian markets via the Pacific Ocean. The strategic significance of this geography cannot be overstated. Shipping LNG from Kitimat to Japan, South Korea, or India is considerably faster than shipping from the Middle East or the Atlantic Basin. That shorter transit time means lower shipping costs, reduced exposure to geopolitical choke points, and faster response times when buyers need emergency supply coverage. This is not a project still on a drawing board. South Korea, one of the largest LNG importers in the world, has already signed commercial agreements to purchase Canadian liquefied natural gas as part of a deliberate strategy to diversify away from Middle Eastern supply routes. The contracts exist. The infrastructure is being built. The shift is already underway. The card nobody talks about, uranium. Beyond oil and gas, Canada holds a third energy asset that most coverage of this story completely overlooks. Canada is one of the world's largest producers of uranium, with major mining operations concentrated in the Athabasca Basin in Saskatchewan. As countries across Asia accelerate their nuclear power programs, driven by the twin pressures of climate commitments and energy security, demand for reliable uranium supply is rising sharply. Canada has already moved to capture this opportunity. A long-term uranium supply agreement with India, valued at approximately $2.8 billion US, was signed to support New Delhi's ambitious nuclear energy expansion program. For India, access to stable uranium supply is a critical component of its strategy to reduce dependence on fossil fuel imports. For Canada, these long-term contracts are not just commercial wins, They are strategic anchors that embed Canada into the energy infrastructure of one of the world's fastest-growing major economies for decades to come. A portfolio no conflict zone can match. When you step back and look at the full picture, what Canada has assembled is genuinely unusual. Massive, proven oil reserves. A Pacific-facing LNG export hub now coming online, long-term uranium contracts with major Asian economies. Each of these individually would be significant. Together, they form an energy portfolio that almost no other country outside the conflict zones can replicate. And sitting underneath all of it is something that does not show up in reserve figures or production statistics: a stable political system, reliable rule of law, and infrastructure that functions predictably. In a market that is being forced to reprice geopolitical risk from the ground up, that combination is worth considerably more than it was 12 months ago. To fully appreciate what is happening, you need to understand how badly Canada used to be positioned in this market and how dramatically that is changing. For years, the structure of North American energy markets placed Canadian producers in a genuinely disadvantageous negotiating position. The problem was geography and infrastructure. Canadian heavy crude, specifically the benchmark grade known as Western Canadian Select, had almost nowhere to go except south into the American refinery system via cross-border pipeline networks. With no meaningful access to ocean export terminals, Canadian producers had effectively one customer: the United States. That lack of alternatives had a direct and brutal impact on pricing. Western Canadian Select routinely traded at a significant discount to international benchmarks like Brent Crude and West Texas Intermediate. During periods when pipeline capacity was strained and export bottlenecks were at their worst, that discount widened to somewhere between $40 and $60 per barrel. Not a rounding error, $40 to $60 per barrel, sustained over months, on millions of barrels per day. The cumulative revenue loss to Canadian producers over those years ran into figures that are genuinely difficult to comprehend. The underlying cause was simple economics. When you have only one buyer, that buyer sets the terms. What is happening now represents a structural reversal of that dynamic. As major importers across Asia and Europe actively seek alternatives to Middle Eastern supply, Canada is no longer in the position of needing to find customers. Customers are coming to Canada. Indian energy officials are expanding negotiations with Canadian counterparts. Japanese and South Korean energy companies are signing offtake agreements. European governments are reassessing their long-term supply diversification strategies with North American producers explicitly in the frame. The gap between Western Canadian Select and international benchmarks is beginning to narrow, not because of any change in the oil itself, but because the geopolitical context around it has shifted fundamentally. What was once priced as a regional, landlocked commodity is being repriced as a strategic global asset. And in energy markets, perception of value has a way of becoming value very quickly. So where does this actually go from here? The honest answer is that nobody knows with certainty. But the range of outcomes is not random. There are three distinct directions this story can travel, and understanding each one matters because the differences between them are not small. Temporary shock, limited structural change. The first possibility is that the tension at Hormuz de-escalates within weeks or months. Diplomatic channels hold, shipping routes reopen fully. Oil from the Middle East continues flowing at normal volumes, and the acute fear that drove buyers toward alternative suppliers begins to fade. In this scenario, Canada still benefits, but mainly in the short term. Spot contracts get signed, prices spike and correct, and the underlying structure of global energy trade returns to something close to its previous form. Canadian producers pocket a windfall, but do not achieve the kind of long-term market repositioning that fundamentally changes their pricing power. The $40 to $60 discount on Western Canadian Select narrows temporarily, then drifts back. This outcome is possible. It has happened before. Markets have a short memory when the immediate threat recedes. Permanent restructuring of global energy trade. The second possibility is the one that energy strategists in several governments are quietly treating as the base case. In this scenario, the Hormuz crisis does not resolve cleanly, or it does resolve, but the experience of vulnerability is severe enough that major importers decide they cannot afford to run the same risk again. The political mandate to diversify supply sources becomes durable and bipartisan across multiple governments simultaneously. Under these conditions, Canada's transformation from regional supplier to global strategic partner accelerates rapidly. The LNG Canada facility reaches full operational capacity and signs long-term contracts across multiple Asian markets. Western Canadian Select closes most of its discount gap against international benchmarks not to zero, but to a range that reflects logistics costs rather than captive market pricing. Canadian uranium becomes a cornerstone input for nuclear expansion programs across Asia. And the infrastructure investments required to support all of this new pipelines, expanded port capacity, additional liquefaction trains attract the kind of long-term capital that locks in Canada's position for decades. This is not a speculative scenario. The contracts being signed today, the facilities being built today, the diplomatic conversations happening today, they are all consistent with this trajectory. Canada's internal contradictions slow everything down. The third scenario is the one that Canadian energy optimists prefer not to discuss, but it is real, and it deserves serious consideration. Canada's ability to capitalize on this geopolitical moment is not purely a function of what the world wants from Canada. It is also a function of what Canada is willing and able to deliver. And on that front, there are genuine constraints. Oil sands extraction is among the most carbon-intensive forms of oil production on Earth. Canada has made significant climate commitments, and domestic political pressure to limit fossil fuel expansion is substantial and growing. Environmental approval processes for new pipelines and export terminals have historically taken years, sometimes longer. The gap between what Canadian reserves theoretically allow and what Canadian policy practically permits is wide and contested. If regulatory friction, financing constraints, and climate policy combine to slow the infrastructure build-out that expanded export capacity requires, Canada may find itself holding an extraordinary hand of cards and unable to play them quickly enough to meet the moment. The world's appetite for Canadian energy may arrive faster than Canada's ability to supply it. 3 scenarios. 1 choke point. And a country that most of the world is only now beginning to take seriously as an energy superpower. Here is what we know with confidence. The Strait of Hormuz has exposed something that energy markets spent decades pretending was not a vulnerability, that the modern global economy built its most critical supply chain through a 33-kilometer gap of water, in one of the most geopolitically volatile regions on Earth. That exposure is now impossible to ignore. What we do not know is whether the response will be lasting or temporary. Whether the contracts being signed today represent a genuine restructuring of global energy trade, or simply a moment of panic that fades when the immediate threat recedes. Whether Canada will move fast enough to convert its resource advantage into durable market power before the window narrows. These are not abstract questions. The answers will directly shape energy prices, inflation rates, industrial competitiveness, and living standards across dozens of economies over the next decade and beyond. So here is what we want to know from you. Do you think this crisis represents a permanent turning point in how the world sources its energy, or will markets simply return to the status quo once the tension eases? And do you believe Canada has the political will to actually capitalize on this moment, or will internal contradictions hold it back? Leave your perspective in the comments. The most interesting analysis in these discussions almost always comes from the audience. And if you want to be here when the next chapter of this story develops, you know what to do.